at the end, but I'll try to move swiftly through it here. For those that don't know me, I'm James Damshutter. I'm the Chief Investment Officer at Gravity Capital Partners. Gravity Capital Partners is a sister company of Gravity Investments, a company I started back in 2000 based on a number of patents and intellectual property in the area of diversification, and specifically diversification, measurement, visualization, and optimization. And what we've learned is these technologies give a special emphasis to people that have outsized concentrations of wealth. And this, often happens in, entrepreneurs or other family office kinds of clients. And as you can see on this list, a number of different, typical sources of these concentrations, from entrepreneurial holdings, executive compensation, pre or post IPO stock concentrations, ESOP concentrations, especially for large plan participants that, whose hands are forced to sometimes invest in the company's stock. But oftentimes it's also inherited assets, for families of the founding entrepreneurs. Or it could be other illiquid investments outside the capital markets, such as land and real estate. And another one that we've seen is carried interest. Carried interest being, shares from the managing partner that are reinvested in venture capital pools, hedge fund pools, or other forms of limited partnerships. And what we've learned is having these concentrated sources, the real demand for any of the investor objectives is not anything kind of in the typical sense of risk or return, but we've got a crucial need for helping those investors to help diversify out of that concentrated source. And that need, not only is it intuitive, it's generally well understood, but there's also some hard science behind it, and that delves into this new science that we've pioneered, which is the science of diversification. So I'm going to take you through very briefly and really just as a backdrop to help you understand the importance and the new capabilities that now exist to help create better asset allocation models for investors having these sorts of concentrated wealth positions. So, irrespective of that source of concentration, and I pointed to a couple of them before, let me revisit that. I'm going to show you an example today of one of these sources being, perhaps a public company that, let's say, one of our clients was either on the executive team of or founded. But we're able to provide this same type of analysis for other investors that the data may not exist for the value of their holdings, and perhaps that's private land or inherited assets. We have the ability to synthesize some of this data to create a proxy asset and integrate that proxy asset into another asset allocation model. So I'm going to go ahead and enter in a hypothetical portfolio here, and I'm going to use, let's just take the Waltons as our example today. So, of course, Sam Walton's the founder, but there's probably the better part of half a dozen of his children and family that are on the Forbes 400 list because of the company's enormous success. And, irrespective of the level of that success, whenever a person has one of these concentrated sources of wealth, again, we've got to help them create a more balanced portfolio that's going to help their performance and decrease their systematic risk by investing in assets that behave less like that position that they're holding. And let's call this particular position, let's call it perhaps $500 million. So, oops, I've got a digit off, but $50 million I think will still make the point. And we'll assume then that the wealth of this investor has an aggregate net worth of $100 million. So in this case, half of the investor's net worth is consumed within, in this case, one particular asset, and that's Walmart. Of course, these concentrations of wealth need not be tied to one single source, but are often, very, very top-heavy, one source, two source, maybe three, depending on kind of the nature of their holdings and whether it's multi-generational wealth. So this means that there's maybe $50 million in a capital market portfolio that you're being hired to help them construct. And what we want to do is find additional investments that don't look like Walmart that still offer attractive risk and return metrics. I'm just going to put in a fairly naive selection of, in this case, exchange-traded funds. And I'm using names that we've all, typically know, just to kind of illustrate the point a little bit better. And we'll see how this portfolio comes together. And typically what happens is because of this imposing position, and in this case, this position being a stock, it's going to push more of this asset allocation to other investments here that don't quite look so much like stocks do. So let me continue adding a couple more options to the mix. And this process, of course, works irrespective of the asset classes that we're working with. You can work with any kind of security around the globe. I'll put in a couple other direct equities in the mix. Okay. And again, a very naive situation. The process works as well, even if we're into the portfolios and hundreds of assets, which is of course more typical with portfolio values of this size. But what I'm going to do here is I'm going to retain this value of $50 million held by Ms. Walton in Walmart, and we know that just constitutes 50% of their overall portfolio. So as you can see, 50% of $100 million has been consumed and allocated to that position. So what we're doing is we're optimizing the rest of these investments to better balance out against that position. And one of the, we in our optimization logic, which is very different than any other optimization process, one of the closer things would be perhaps mean variance optimization. But what we've done is we've separated diversification from being just a kind of component of risk, and we've parsed it out to make it its own freestanding variable in the portfolio construction process that, by being able to, measure and visualize, we can then, work with, and this is what's unlocked this ability to help these types of investors. So one of the outputs of our system are these portfolio visualizations. And very crucially to this visualization is that the level of symmetry that's imposed by this portfolio gives us a visual explanation of the level of balance that that portfolio has achieved. So the more round or symmetrical, the better job we've done of creating a diversified portfolio. We use both these boxes here as well as a globe to just sort of represent what perfect balance or perfect symmetry can look like. So in our three-dimensional world, there's nothing more symmetrical or balanced than a sphere. And by evaluating just the simple shape of that portfolio against that sphere, we can get a very rapid intuition about the level of balance that it's achieved. Now, our optimization logic is directly intertwined to this three-dimensional geometry that we see here. And I'll circle back to that optimization logic in just a little bit as we walk through our example together. But just going from left to right in these three illustrations, on the left we have a style box portfolio. So this is your large cap, small cap, mid cap, value, growth, and blend. So it's all equity, and as it turns out, by dividing up the universe of equities into those types of indexes or funds or what have you, is a very poor way to cut up the universe of equities from a diversification perspective, because we have a lot of these investments that are literally kind of going the same direction. And we see that geometrically here, and there's a pairing in that geometric concept to the economic concept of that, but it's really driven by the correlations. So highly correlated assets are going to be assets that are going the same direction and have very highly related vectors that all push out the same direction from that center point, and the center point we use as a cash equivalent, or otherwise a hurdle rate. Going to the middle portfolio now, having introduced a little more diverse set of investments, we see that the allocations to bonds help give the portfolio this new exposure. They literally take that portfolio in a new and different direction, and the shape then that is imposed by that portfolio is now more symmetrical. Of course, compared to the sphere, it's still very asymmetric, but it's doing a better job of helping to round out that portfolio. So it's a step in the right direction, but in our way of thinking, it's still a bit insufficient. This also ties then, of course, with stocks and bonds not offering, particularly great diversification. This is the area where, alternative investments, liquid alts tend to have a larger role because those are some of the, better sources of non or negative correlation to any portfolio. And by integrating, more diversification enhancing type of assets, we're able to get a footprint for the portfolio that offers a greater level of symmetry. Now, notice it's not exactly like a basketball here, but when we look at the portfolio with these boxes, we can see that we've gained some level of exposure in this portfolio in every single box. And a box just represents diversification potential. Whether that diversification potential is manifest, as it is here, because you can see the simple exposure of that portfolio into that box, or if that exposure, the diversification potential is just more hypothetical. In this case, we've got a lot of missing boxes, so these would be, empty diversification, where there's an opportunity to gain more diversification by integrating new investments that do a better job of diversifying out of that which is, in this case, held. In this case, it's just those style box type of strategies. So with that as a little bit of a backdrop to the methodology, let me return to our software. Our software is called Gsphere.net, and we began selling the software as a standalone back in 2003, and we served about 100 different investors, fund managers, family offices, fund consultants, RIAs, and over the years, we helped a lot of those managers really architect their strategies using the software, and the software was used to advise or manage on $20 to $25 billion of capital. About 3 years ago, we set up a sister company called Gravity Capital Partners that really delivers the results produced by the software as a investment solution. It's available as overlays, as separately managed accounts, or in a outsourced chief investment officer situation. Okay, a couple different ways to optimize a portfolio, and having diversification now separated from risk and return allows us to package risk, return, and diversification as we see fit. So we could emphasize risk, we could emphasize returns, and thus tilt the portfolio to be more aggressive or more conservative. I'm going to take on an approach that is called the diversification maximization. And we get this diversification maximization. I'm just setting one of the kind of parameters of the optimization. This takes place when we basically ignore the information about risk and return. So whatever this information is, we're not letting it affect ultimately the utility function that combines with diversification to produce an optimization. Okay, now I'll make a second example in just a little bit where I'm going to allow a little bit more of that information to permeate the optimization results. The only other thing I'll do at this point, I'll add perhaps a maximum constraint, just to say 20%. So no other additional holding will take on more than 20% of that capital. Which probably wouldn't it wouldn't happen anyway under a diversification maximization context. But here we go. Now, when I optimize this portfolio, we are deploying a genetic algorithm, and that genetic algorithm has really one function to it, and that function is to find the best fit for all of these coordinates, so that these coordinates describe the level of balance that's achieved in this portfolio as accurately as possible. So it's almost like a projection technique. I like to give the analogy of a cartographer or a map maker, and typically that map maker starts with the 3D Earth and projects 3D to 2D on a map, so we could see see the relationships and see the sum of the whole, which is the definition of holistic. Now, this is doing the same thing, but instead of starting in this high dimensional space, or I'm sorry, instead of starting in 3D and going to 2D, we start in this high dimensional space and end up in 3D. The reason we want to end up in 3D and not push it all the way down to 2D is so we can capture that extra dimension of information, which conveys just so much more than you can in 3D. Unfortunately, limitations as humans prevent us from, better analyzing this in, 5, 6, 7, 8 dimensions. We can see, let me go ahead and stop this spinning, but you get a sense for the overall level of footprint of the diversification available into this strategy. And from an asset allocation perspective, actually, before I do that, let's talk about the relationships. And there's a view I like to use when looking at the relationships, and it's really explained by these vectors. These vectors really are defining the relationships. So let me find Walmart on here. There it is. So Walmart, as I've got this oriented, is sort of in the 12 o'clock position. And apparently, Walmart looks a lot like Yahoo. Those two would be fairly highly related. It's a little bit of a surprise, but this happens all the time. And by the way, I should mention diversification is a moving target because correlations are moving. So we've developed some best practices that look at correlation regimes and look to optimize the predictive value of the correlations by looking at the right combination of historical time periods that will best serve the relevance and objectives of the investor in their portfolio going forward. So if Walmart and Yahoo look a lot alike, what are the better assets then that are going to diversify away from that? And the answer to that are assets that are literally taking the portfolio in a new direction. In this case, fuel. This is a company called Rocket Fuel, and you can see how that's almost 90 degrees separated from Walmart. This means 90 degrees would be it's uncorrelated. It's taking the portfolio in a new direction, and when we volumize this portfolio, fuel then becomes responsible for adding a lot more volume to the portfolio because it's so unique. So some of the other investments that are better volume adders, and in our world, volume is capital. So irrespective of whether we're allocating your friend's IRA account or we're working with the Gates Foundation, whatever that amount is equals the overall dollar value. The dollar value equals the volume of the polytope. And from that perspective, it's just a very simple process of pro rata volume division that determines the optimal weights for any of the assets. So assets then that are more similar to each other. For example, here, this is interesting. Over this period, we've got both real estate, the S&P 500, and the bond index actually looking very similar to one another. So these assets are literally fighting for that same space in the portfolio, and because of that sort of fight and those high correlations, they end up crowding each other out. So the assets that are going to receive more of that available capital are going to be assets like gold, fuel, silver, and then to a lesser extent, assets like emerging market bonds, emerging markets, Verizon, short-term bonds, because they're serving a more unique area in that portfolio and extending that portfolio into that unique space. So in this example, you can see that all of the different lengths for these vectors are identical to each other. And because of that, that's the diversification maximization. That means that we're not allowing our our thoughts or opinions about risk or return forecasting to impact the asset allocation. And as we, I guess Walmart's been a real dog here, isn't it? As we look at the weights that we produced from this optimization, well, I'm going to have to run that back again. I accidentally put a maximum constraint on Walmart of 20%. Let me come back and just take that off real quick. So I'm clearing all these asset allocations. I'm keeping it at $100 million. I'm adding a 50% allocation to Walmart and making sure I don't have that constraint as I did the first time. And now let me optimize this again. That makes a little bit more sense. So as you can see, that the portfolio is very much overweighted and tilted towards that Walmart position. You can also see that the allocations, and we can just sort these here. The allocations that are providing the highest weights into this portfolio are those same ones that I showed before that have a more unique space in that portfolio. SHY, gold, and fuel. So, as these portfolios especially get more complex, it becomes even more important to find these investments that do a better job of diversifying out of what that investor has. And one of the ways that we have to help those investors kind of understand what's going on and evaluate that, and sometimes this could be used then to evaluate both an existing portfolio and then again to be evaluate a recommendation, is looking at the levels, the portfolio's exposure to systematic risk. And of course, the more concentrated positions you have, the more exposure you have to systematic risk. Systematic risk, of course, might change from investor to investor, but it's still generally, the market risk. Of course, when you have big positions, those positions become your systematic risk. And we can see here, in this particular portfolio, we've got a portfolio which statistically acts as a one-dimensional portfolio up through 60% of that portfolio's value. And really what we'd like to do is to do the best job we can of shortening this first step and creating a portfolio that has better stair steps across the spectrum, so it kind of more hugs this diagonal line, and thus it would have better sources of diversification integrated into that. And the source of diversification is essentially like an equally weighted, uncorrelated asset. And for example, if we had a portfolio of 8 equally weighted, uncorrelated assets, this would be like it would be a perfect diagonal line. But because we've got big positions in Walmart, because we've got some correlations, in this case positive correlations amongst a number of the other positions, that's bowing in. Some of that's going to be inevitable, especially for clients that are so concentrated, but it's our job as fiduciaries to do the best we can, to help them, remove some of that balance. So I'm going to take one more run at this portfolio, and this time, instead of just using diversification maximization, I'm going to go through and just apply some, we've got a lot of science behind this, but I'm going to take a very basic example of using some of the more risk and return forecasts and integrating that into the optimization. And one of the ways we like to do that, I'll go ahead and define risk here, but by applying these shrinkage processes, shrinkage is it's called a James Stein estimation, and essentially the more we shrink something, the more we move it from none, slight, down towards average, the more we're essentially dialing out that variable, in this case risk, in that portfolio optimization process. Now, with a portfolio with such a concentration, I would tend to think that investors' objectives are going to be more along the lines of reducing their systematic risk, and then maybe a little bit less emphasis on the return side of the ledger. So I'm going to do more of a job of shrinking the return forecasts down. And again, this is a fairly naive set of return forecasts, but we've got a lot of best practices developed in helping to systematically and quantitatively forecast returns. And I'm going to use a smaller level of risk shrinkage. So what this is doing, it means that I'm going to let the relative differences in the risk values for these assets be a bigger driver in determining my vector lengths. A vector length is a utility function. And in a broad sense, utility could be like a risk-adjusted return, but for many investors, utility is total returns, or maybe utility is current income, or utility is just don't lose any of my money. Whatever that investor's definition of utility, we can set that to be equal to the quantification of utility in the system. That quantification of utility then combines with diversification to produce the recommendation. So with our risk and return values set, let me re-enter that concentrated position in Walmart, and I will optimize this portfolio. Okay. So, we still have an outsized position in Walmart. I can't do anything about that. That's just what it is. But what we have done is we've shifted the allocation weights, and we're going to find now that on the margin we're picking up more allocation in less risky investments. So ideally, in these examples, I just put a few names in there of some stuff that would be more readily apparent to us. But we want to include, obviously, more investments. And by having more investments, we're going to have more opportunities to get good diversification. And with our process and using Gsphere, Gsphere will basically automatically designate which of those different investments make the grade from a diversification perspective, and add the the weight of the portfolio to those as appropriate. The other thing that that the process does, which is has some strong parallels to Markowitz's mean variance optimization, but in diversification optimization, it's a little bit different. It's diversification utility, and you can actually see the assets that are inefficient. So in this case, all these investments that are rising to the surface of the model, are the investments that are doing the best job of increasing, that portfolio's efficiency and helping to grow that portfolio in an efficient manner. And we could also see, actually, I'm going to switch this to my desktop software to illustrate this point. In this case, I've got a healthcare sector portfolio up, and the healthcare, we're using the same process by mapping those correlations to these angles, and then taking all that investor objective and risk and return information as a vector length function, to create these coordinates. Once we have these coordinates, we're then imposing, this, in math it's just called the convex hull. But in an investment sense, really this is a 3D instead of 2D and holistic instead of relativistic version of the efficient frontier. It's kind of like the efficient frontier that's, unique to any one portfolio. And from a portfolio efficiency perspective, we can see that there might be certain investments that are stuck inside this portfolio. So even though they might have been, perfectly good investments, based on how all this portfolio comes together, and that's all that matters, right, is how everything comes together. That's how we're regulated. These assets are doing an inefficient job of growing that portfolio and adding balance to that portfolio. So those assets are removed from the system, ensuring that only the optimal footprint of investments that are adding the right combination of risk, return, and diversification, get the allocation. And then, of course, you take whatever that volume is and cut that volume up to determine the weights where your more unique assets get your larger weights. And this is another one of the areas where Gravity excels, because diversification is generally fairly misunderstood by so much of the both professional and investing public. Using this to teach those people about diversification, as well as giving them some tools. For example, if we wanted to add some diversification fairly rapidly on top of this portfolio, Gravity maintains a number of what we call candidate sets. A candidate set works as a diversification overlay, and given any portfolio can be set as it's kind of like a list of ingredients. We haven't designated any of the weights to it because those weights should be a function of what's already held in that portfolio. That's why it's an overlay. So I'm going to add two different candidate sets, in this case an alternative and aggressive income, and we also keep one, here's one for liquid alternatives. So by applying these two sets of investments that we regularly maintain and evaluate and call and monitor, and integrating those as investment options on top of this portfolio, in this case is going to be serving as a diversification overlay, so that we're going to find a stronger footprint of investment options to help take this already concentrated portfolio and really try to squeeze out as much diversification as we can, so we're lowering the overall systematic risk for our investors. And I'm going to make one quick edit to my my investment policy tree. I'm going to allow this optimization to run in 5 dimensions. So all of this mathematics and computational geometry that works in 3 dimensions, it could work in any number of dimensions. And by allowing it to work in a higher number of dimensions, we're going to allow that to be a little bit more marginally forgiving to you know, to kind of bubble assets. So, but in that sense, we're having the optimization do a better job of managing the non-systematic risk to the portfolio. Okay, so it's the same thing we had before, but now just instead of looking at, you know, a couple of the usual suspects in the ETF world and, you know, a couple of those stocks we threw in, you know, we're looking at a set of investments that we've explicitly cultivated as being better sources of diversification. So we don't know yet whether they're going to be good diversifiers against Walmart, and then obviously be different evaluating against Walmart as it would be, you know, evaluating it against, you know, Microsoft. But at the end of the day, we end up with a portfolio that's going to do, you know, the best job possible of maximizing its available diversification to provide the, you know, the best fiduciary product to that end investor. And as you can see here, you know, again, it's not a basketball. There's still you know, a reasonable portion that's omitted here because we haven't got in, you know, on the short side. We're still in a long-only portfolio, but we've found investments that are going to give us a lot more cover, a lot more exposure, decrease that systematic risk to the portfolio, all the while, you know, if we've done our job in evaluating those investment opportunities, you know, without decreasing that portfolio's overall return or return potential. Well, that's all I had for this webinar. Appreciate your time to tune in, and feel free to get in touch with us if we could be of service to you or any of the clients that you serve. We'd be delighted to work with you. And again, thanks for your time and have a great afternoon.